Morning, guys.
Hello. Hello. Hi.
Nice to see you all. Okay.
Yeah.
Yeah. Hope it's not too early on a Sunday.
It's reasonable. I'm fine.
But too early for me.
Fantastic.
You probably figured out from my WhatsApp message timing that I'm more of a night person.
Yeah.
How's everyone?
Good,
All
great, and I think actually it's a great initiative, especially people like me have no idea about this financial market. And it's been a sort of like eye-opener for me to learn so much about investment opportunities and all. So it's a great initiative, and I really love the way you organize the whole thing. Yeah, great.
Well, that's very nice of you to say, Vinod. I just did one thing, which is open the WhatsApp group. It's everyone who's chipped in and doing the messages. So as you say, it's an initiative by all of us.
I agree. Yeah, but you've taken the initiative. That's a great thing.
Yeah, and it's lovely to see all of you coming today as well on a weekend, so early. So I can see there are about 21 of us here. I mean, it's early, so people will probably join in as they come along. It's kind of spur of the moment decision yesterday. So there was various questions, and a couple of people have left our group as well because they felt it's a bit too much beyond their head. They said when I approached them separately because they felt they were beginners, and the discussions some of us were having kind of to some extent intimidated them, it seems. So I thought, okay, that defies the purpose of the group. So let's kind of have this meeting on Zoom just to kind of give that opportunity for me at least to hear where the so-called beginners, I mean, I don't like that word, but people have been using that, beginners and starters, to see where they are. There are any specific kind of issues around investing, but particularly stock market, US stocks. That's my kind of interest.
Yeah, you did mention that. Yeah.
And of course, as you can see on the video, people are of different levels in our life stages. So and different priorities will be there. I'm having a bit of an echo. So I don't think anyone can give a specific personalized advice to any of us in our circumstances. We can talk about general foundations and any questions about investing approaches and where to start, how to go, any kind of guidance and things like that. And I mean, we're all professionals, so hopefully we'll maintain that confidentiality and treat everyone with respect and all that. Feel free to share only that you're comfortable to share, and if you wanted to kind of approach anything confidential or anything personal that you don't want to share in the bigger group, you have my number, so you can always text me on that if you need to. I don't know whether people have had any kind of thought put into what you would want to kind of check discuss today. And let me see. Okay, that's somebody asking, is anyone recording? So I think the recording facility for Zoom is for on the subscribed model, but as a host, there is an option to record locally on my computer. So on top of my screen, it says it's recording. I don't know where it is recording to, so I will know when I finished, if I have access to it. Hi, Nan.
You can record on your laptop screen. If you're using a Mac, it's a QuickTime player. But I think I've always struggled to convert it into some other format. So I've left a couple of recordings in my laptop, they never watched them before. It's
Right.
probably for the school or the school and the college medical school meeting.
Yeah. So my experience is once you finish the recording, once you finish this meeting, the recording will take some time to convert. So you need to keep your computer on for like 10-15 minutes, and then it will be saved in a default folder in your hard drive. And then you can access it, and then you can change the format as well subsequently. You can edit and change, you can cut the parts which you don't want. that can be done.
You can put it on YouTube where everybody can see it, you know, or when they want to.
Yeah. Well, yes, let's first see if this meeting is useful for all of us, for all of you guys. And if it's really beneficial, then we'll do that. Of course, it's recording, it says on my screen, on my local laptop. I'll have a go at the format and things like that after we're finished. Nance, I want to thank you for some of the recent posts that you put, really helpful comparing various ISAs, SIPPs and things like that. That was really helpful.
Perfect. You know, I think I'm still learning. I would say, you know, I've been 5 years trading like a pendulum here and there between big losses, but haven't moved forward. Okay.
Yeah.
In the last 3-6 months, I've decided to challenge myself. In 2-3 years time. Hopefully I'll gain some knowledge. And, you know, I think the knowledge has made a big difference. Without reading, I would say you would swing and, you know, you would do everything, but I think you'll be lucky if you progress forward, I would say.
Yeah, I should also say to everyone that the fact that we are thinking about it and we have taken this step to contribute, be part of this group and meeting today, kind of sets you up above majority of the population, right? Not many people are aware of the investment, aware of, I'm not just talking about stock market, but generally financial literacy is not widely present. And we are all considered to be the cream of the society, right? In terms of being a medic and being consultant and higher in our specialty. But how many of us had that knowledge? I mean, we, as quite rightly mentioned in our group, it's not taught in our school or university. Sometimes our parents taught us something, but that's not even widely the case either. So majority of the population don't know what we are doing right now. So that's why I don't like the word beginners or starters, because we are much above many of the people on the wider society. So I just want people to realize that you're much ahead of all of those people. And you do have quite a lot of knowledge from other parts of your life and career, which we can transfer into some of these skills. So because I haven't invited anyone else other than from our WhatsApp group, so all of us would be doctors, right? Medicals or in our medical field. So we, on a day-to-day practice, what's the first thing that we do? Hippocrates is do no harm, right? In clinical practice, we always think in terms of what's the risk? Let's reduce the risk. When we think of different medication with the same efficacy, we choose the ones with lowest risk, right? And that is the same principle in investing as well, or in building our financial wealth. Go with the safer ones to start with. And then as you build your confidence and knowledge and experience, then you can think about kind of adding a little bit more risks to that. If we are a foundation year doctors or a core trainee doctors, we won't expect them to take on really complicated, risky procedures. We ask them to go by the process, follow the letter of the law, like dotting the I's and crossing the T's, in order for them to learn how to kind of do the things in a right way, not cut corners, manage the risk, right? But when we become registrars and consultant and senior consultant, we kind of jump some steps. We know where to cut corners safely, right? And that doesn't mean that SHO should be feeling inferior looking at the consultant, but it's just different phases of growth and learning process. And that applies with investing as well. So don't feel like Pratik or I are dealing with different stocks or option trading. I think Raghavendra, I don't know whether Raghav is in the group today. He has also invested in EIS, which I have also done. So those are all different vehicles to do that. It doesn't mean that all of us have to do the same thing. All of that comes with different risks. For those who haven't ever started or have any knowledge of it, the best and safer way, of course, is index funds. If you want to have any kind of dipping your toe in stock market, because over the long period of time, that gives you really good return. And I'm conscious that I'm saying many of the same things that's been discussed in the group. Shall I kind of ask you if you had any specific topics that you would like to kind of check with me or discuss as a group today? And can I ask for a volunteer to maybe take a note of that, or like a minute?
I think I'll try and do it. Okay, I'm not very good with writing and things, you know. I'm an anesthetist, so I just scribble things the same boring way all the time. But I'll try. I'll make an attempt.
I'll take notes as well.
Great. What's
and
your
then
name?
we can
Sorry.
combine.
Yeah, sounds good. What's your name again? Sorry.
Mine?
Yeah.
Ragini.
Ragini, hi, thanks. I know you're kind of raising your hand, but it says R-K, so I don't know. Don't know what's your right name. Ragini, thank you. Yeah, Ranand and Ragini can take some notes and collect it at the end. The ideas I had in my mind is just to talk few of them. I'll say what I had, and then people can chip in. I thought I will talk a little bit about index fund investment, passive investment, the power of compounding, which is widely kind of mentioned as the eighth wonder of the world, and individual stock investing, US stock investing, which is my area. I have done a little bit of UK dividend investing, but I've kind of moved out of it. I just have one UK stock at the moment as long-term dividend investment. I've closed other bits. So I can talk about US stock investing and maybe a little bit about why that happened. Go ahead, John.
Sorry.
I thought you had your hand up.
Can I start asking questions so that we can move forward?
Yeah, go ahead, Mohan. Either questions or let's get a list of questions or themes to talk about in the first couple of minutes, and then we'll go one by one.
Vinod, many thanks for taking this initiative. Already, Vinod Sanam has mentioned actually. It does show how motivated you are and how much that you care for others, passing on the tips, and also many other members, including Pratik, and I can mention so many names. I don't want to waste time actually. So you've started off saying funds probably the first option, considering the risk versus benefit. So people, at least some of us, are starting to know things. So how do we go about get to know, like when we start reading anatomy or whatever that we have discussed? How do we start this process? Some members have sent now some platforms comparison. So apart from that, first of all, we need to know the theory behind, like you mentioned. First we are MBBS students, only then become a F1 or a CT1. So where do we get this information? Is it online, or is there any books available? Yes, a lot of books you have mentioned, but is there any that you can click on? One or two that you can click on.
Mohan, just one second. Can I ask attendees to maybe mute on their side when others are talking, so it's not interrupting? Thanks. Thank you. Go ahead, Mohan.
Yeah, so you mentioned about 10 books or so, and few others also mentioned. Is there any just a few books that you can suggest to start off, whether it's funds investment or in the form of share dealing? Looks like other things are too complicated.
Yep, that's a good point. Yeah, we'll go through those one by one once we collected the topics. Thanks, Mohan. Sorry, kids, your mom and dad so busy. Any other question? Topics of interest?
Can I ask about your ideas on SIPPs, as well as whether you've invested in it, number one. And number two, yes, I have received a very useful link to ISAs. I know some of you may have invested in ISAs. There's a bit of confusion about ISAs in my mind, basically about the vast array of investments that you can do. Now, Could you clarify what would be safe investments in those and what are those in terms of? And also at the end of 1 year, let us say I invest 20 grand in a stocks and shares ISA. What's the difference between a stocks and shares ISA and a cash ISA? It's very basic stuff. Does it mean any difference? Are the returns any different? And can I reinvest that back?
Somebody is rustling.
Stuff like that, please.
Yeah, sure, John. Thanks. There are a few of us just joined. So can I ask attendees to mute themselves when somebody else is kind of asking a question, so it's not interfering. Thank you. And there's also a chat section. Let's first kind of ask orally through video and audio, and then subsequently we can put things on chat. Otherwise, it might be difficult to keep track of both of them.
Sorry, Vinod. Actually, if people are not muting you, I think you might be able to mute them. Actually, of course, it may not be right, but just to keep the conversation going.
Yeah.
I think you can raise your hands in the reaction when Vinod mutes, so that Vinod can know whether you want to speak or no sometimes in between.
Okay. When we're all professionals, so I thought I would give the responsibility to
unmute is better. I think unmute is better so that people can ask questions. If it's too much of disturbance, we can review this situation again.
Yeah, cool. So Ragini and Nand, I hope you got both those kind of questions that people have asked. We'll go through that in a second. Any other questions, Satish ji?
Yeah. I just want to ask, what's the difference between an index fund and an ETF?
Okay.
And second one is, because I have invested in stocks and shares ISA, but I didn't understand what is SIPP.
Okay. Yeah.
I did read about it actually, because it's a pension. I understand that it's pension.
Yeah.
But if we say when you're working, your money or it gets deducted from your employer and you pay something in that. So I thought that is a default thing and you can't do anything more than that. So I don't understand what is this extra SIPP. So I've not invested anything in that. So I want some clarification regarding SIPP.
Of course, sure. Yeah, and that's similar to John's question as well. Yeah, thank you. Taranji?
Thank you, Vinod. First of all, I'll just mention this thing for Vinod's benefit, that although we are all professionals, but nobody can give advice, financial advice. It's a legal thing, because yesterday, John, you were there as well in the Leeds meeting, and then they said they are not responsible.
You don't need
They are not responsible for the thing. What I wanted to know, is there any way of investing in government bonds through ISAs or not?
Okay.
But this is for later on.
Sure.
You don't need to answer just now. I just wanted to add one more question from my side. Thank you.
Thanks, Taran. Balaji, you got your hand up. You're mute. Let me unmute you. Can you unmute yourself?
Oh, yeah, I've done. Thank you so much for arranging this. I mean, on a Sunday, arranging something and for others' sake is great. The thing is, as you mentioned earlier, we are in a stage not having the knowledge of anything. That's preliminary. The reason probably the group who is here are all in that stage. To gain the knowledge, I think we need tips from people who already know things so that we can learn it very quickly and try to make decisions of risks and benefits so that the medicine could be chosen.
You're using the analogy I was using earlier.
Yeah. I've copied it. That's a good way to put it. Yeah.
Thanks.
Thank you.
Just as I'll try my best. I don't know everything. I'm not a financial expert. Just want to mention it at the forefront. I never invested in bonds, so I have little or no knowledge on that, I'm afraid, Taran. I think people in our group have invested in bonds. So we could probably reserve that question for the wider group when we go to the WhatsApp and get some advice from them. But I can talk about the other things that's been highlighted.
Yeah, thank you.
Just last 1 or 2 minutes to get some topics. Any other questions or topics that people?
I'd say, is anybody speaking? Vinod, I would say pension is my blind spot, to be fair. You know, you have NHS pension, but we don't know whether SIPPs, contributing to SIPPs, would eventually, you know, make you more tax prone, you know, when you're withdrawing, when you're 55, 65, 75, you're locking in for a great amount of time. And a couple of things. I've never got a good pension advice and I'm looking for it, but obviously from a financial advisor, but that's something we could highlight, how different channels of pension and what is an average consultant when at 60, when he retires, contributing to the pension, or the pension pot? Are we contributing more? Are we contributing less? Or can we benefit from it? Or what's something? Those are very wide questions just on pensions, to be fair.
Sure. And then Ragini, can I also maybe ask for your favor to maybe have a look at the chat section as well? There are a couple of questions that come on the chat side.
Yeah.
Make a note of that. Thanks.
So I think, you know, just before you start, I was gathering the theme for the different questions. So yep. I'm thinking, you know, people are interested in knowing, you know, is investment safe? That's one first thing, a doubt to clear. Then the second one is, you know, it's SIPPs and stock ISA differences and, you know, how long, what, or for. Then they want to know about index funds and ETF fund. It's a tiny, small difference, but, you know, what is passive investing? And obviously the risks and benefits of investing, and I would say long-term and short-term investing. These are something to talk about.
Just 1 second, please. Guys, sorry, just give me 2 seconds. Let me take this call. I'll come back in a second.
Do you want me to start something about it? Guys, I think just a starting point is, you know, there's a, I think I'll start with the basic, you know, whatever, you know, investment you do, you have to compare with the rate of inflation. For example, you know, the rate of inflation is 2% in UK. It will be 5 or 7% in India. So if you put an investment anywhere, you know, whether it's house,
can we ask Sirish, your iPhone is giving us the disturbance. Can you please go on mute? Sirish's iPhone is speaking. Yeah, thank you.
Okay. So any investment you make will have to give you growth higher than inflation. You can go back and look at Google search, you know, to see what inflation average has been in UK, US, and India. If your investment is giving higher than growth, the inflation, that means your investment is growing. Okay. The growth might be different in different times, might be different. It's higher in stock, might be little less in gold, might be higher in, you know, properties, might be higher in state. But what you have to take into account is the higher the growth is, you know, not necessarily. If you're going for a riskier investment, you have to risk your capital. And the whole idea about investing and investing learning is to preserve your capital, which means how much money you're investing, and then see how much growth you can get. And this growth, it can be short term by investing for a day, which is called as trading, which you need high level of knowledge, or can be, you know, active and long term, which can be 10, 15 years, or it could be also, I think I'm forgotten the last time, you know, where passive investment, where you're not doing anything, you're selecting somebody. Like example would be selecting Vinod to choose everything for you and you give him the money. That's called as a fund manager. Okay, but you need to be officially qualified. Even Vinod I'm not getting your bad name, Vinod, don't worry. A fund manager can lose or make money for you. So nothing. So to be fair, in a simple line, when people say, is my investment safe in 5 years? Or whether it's, no, you're taking a risk, it might not be safe. But the idea is to invest at the right time. And if you think, you know, you're going to take it out, you take it out quicker. Okay, but nobody can. There's no right or wrong time. But obviously, over an average period of time, if you're in a good company or a good fund or index, you will make money higher than inflation, and that's where your growth is. I'll pass it over to you, Vinod.
Yeah, sorry about earlier. There was an on-call issue. I'm not on call, but because there was an on-call issue, I'm local. They started calling me. I'll mute it. They might still call, but yeah. I'm sorry, Nand. What was the question you were addressing there?
I think I was trying to say, what is a safe investment? I've told them, any investment you do, whether it's real estate, stocks, has to give you growth above inflation.
Sure.
And no investment is safe. For stocks, you'll have to take a higher risk.
Yeah.
Government bonds maybe the next safe, gold and everything. So wherever you're taking risk, the idea is, to kind of invest where, there's more potential to grow, and come out when there is no potential to grow, or something like very similar like that, And then I've talked about passive investment.
Yeah, I would say when it comes, this applies to most things in life, but certainly very significantly for anything to do with money and investment, that the risk is relative. We can't think of risk as an absolute present or absent, because there isn't anything in life that's risk-free, right? Whether it's crossing the road or going to work that we do during COVID times. So we are all kind of wearing PPEs and all that when we are going to work. And we are taking a relative risk there. We know that we might get COVID if we are exposed to it, but we reduce that by wearing the right PPE, by having the right hygiene measures, right? So that, I'm using that example because that is close to what we do on a day-to-day basis. So that's what we would be doing should be doing with our money as well. And we do that all the time when we go for shopping, whether it's grocery shopping or, I don't know, phone shopping or the Black Friday that came up. We kind of shop around, don't we? Why do we shop around? We kind of go to comparison websites for home insurance, car insurance, all sorts of things, because we want the best deal. We want the initial outlay to be most effective for us. So we do the same kind of risk-managed approach for our money as well. But that is risk. There is risk. And Nand mentioned about the mutual funds and things like that. Yes, there are people who unfortunately had bad experience as well, me included. There was a really high flyer kind of fund manager in UK. I think, Nand, you invested and I've invested in that person.
I haven't, but I've heard about him.
So he was well recognized, highly reputed fund manager. He moved out of that organization, created his own fund. I invested for my wife, and many of others did. And then that turned out to be a really bad investment. A lot of people got money stuck in it, and I lost nearly 50% on that. So there are risks, but I didn't put all my money in it.
Is that Neil Woodford?
It is Neil Woodford, yes, indeed. That's right, Amit. So things like that happen. And it is those kind of experience made me kind of realize that actually no one other than me has the best interest of my money. And because I've earned it, I've kind of worked nights and weekends and really hard, blood, sweat and tears, as we say, to earn this money. Who else other than me will have the best interest on my financial future and my kids? So that's why I kind of taken it more on myself. I read, I kind of take what others are saying, but I make my own decision based on that. So coming back to the question of investment, so it's about managing the risk. It's relative risk, and it can be managed, it can be reduced. And because you're taking it in your own hands, whichever way you choose, whether it's passive funds, mutual funds, or your own stock investing, we have a system in place to get out when it's not working in your favor. So you keep that control with you, if that makes sense. Nand and Ragini, could you maybe ask from the top the questions that people have asked? I can go through one by one.
Should I say difference between stock ISA and cash ISA?
Cash ISA. Okay, I think that's the question from John. I think many people might also have that. So so ISA is the tax efficient way of saving. So if we save money in bank account or FD, we get interest on it, but we pay tax on the interest. And being a senior clinician in NHS, we are probably already on the higher tax bracket. So for saving interest, if it goes beyond a particular amount, which is I think £300 or something per tax year, beyond that you will have to pay 45% or 40% tax on it. Even if it is £10 beyond that level, you have to pay that amount of tax. Whereas ISA, you don't have to pay tax on the dividends or any interest that you gain from it. When I first came to this country, the bank interest, and as a result, cash ISA had about 5.5% interest paid on that, which was very close to about 78% people say in the long-term stock market. So I didn't even think about stock market then. I had quite a lot of money on cash ISA and getting nicely cash interest every year. But we know where the interest is now, right? So it's what, 0.25, 0.5 for that's Bank of England rate. Most of the cash ISAs pays about 0.1, 0.15% interest, which is minuscule. It doesn't even take care of the inflation. So having money in cash ISA is pretty much like liquid cash, like sitting in the bank. And that has a role because when you need cash immediately for any kind of family commitments or any emergencies, you need liquid cash. Don't put it in some illiquid investment like a big property or closed funds that you can't take for a few years if you needed money in the next few years or next few months, right? When you, the general piece of advice for stock market investing, whether it's stocks or funds, is just invest the money that you don't need for the next 3 to 5 years, so that you allow yourself the best chance of gaining, having a profit, and also having decent profit in that period, because it always goes up and down. So one of the very famous investors, I think it's Warren Buffett or somebody else, when he was asked, what do you think will happen to the stock market next year? He said, it fluctuates. Because no one can predict. Yes, it goes up, it goes down, sometimes it goes sideways. No one can predict. But in longer term, 3 to 5 years time, it goes up by at least 70% of the times. It doesn't go up 70% of your value, but 70% of the times it goes up. And in any given 20-year period, in the last 120 years or so, no 20-year period has ever lost money in stock market. So 100% of the time people have ended up with a profit if they have invested in any given 20-year period. And that is including the Great Depression in 1929 and various other kind of crashes and collapses in stock market. Even if you bought at the peak of 1929, 20-year period, you made money. Even if you bought at the peak of the dot-com boom in 2000, you made money in 20-year period. So that, I'm not asking everyone to invest for 20 years, but that gives us an idea, right? So if you invest for a few years, you are improving your odds of ending up with a profit. And that's a bit of risk management, right? If you invest today and take your money out next month or next week, it's more like you're risking with a potential loss. It can go up, and you may want to take some profit on it. That's okay, but it could go down. And if you wanted money next year for, say, our kids' university, or there's a wedding coming up in our family, and we want to contribute and things like that, then there is no absolute guarantee that we will have a profit from it. So have a longer term horizon. So invest the cash that you don't actually need for the next 3 to 5 years. So I don't use cash ISA, coming to the question, I don't use cash ISA anymore because there is not much of an interest in it that I gain. So I go for stocks and shares ISA. So it says stocks and shares ISA, but it also includes funds in it. You can also buy funds in that. You can buy funds, you can buy investment trusts, you can buy ETF. So fund is, as Nand mentioned earlier, so say I'm a fund manager and I like 20 different companies, and I start a fund, I collect your money and invest in those companies, right? And I track those companies in a portfolio, and that's a mutual fund. ETF is something, whereas index fund is I will track every company based on the proportion of how much it makes in an index. So we have Sensex and Nifty in India, FTSE in UK, NASDAQ and S&P 500 in US. So S&P 500, I think, has 501 companies for some, or 505 companies in it for some reason. NASDAQ has 100 companies. Dow Jones has 30 companies. I think Nifty, is it 50 in India? Yeah, Sensex has 30 companies. So if I have an index fund following Indian Sensex index, I will buy the same 30 companies at the same percentage as it is reflected on Sensex index. And when a company performs better and becomes bigger, then I add to that because that's what the index is doing. When a company performs poorly and goes out of the index and new companies added to that index, then I do the same. So I'm copying everything that the index does. And that is index fund. Because I'm copying the index is doing, I'm never ahead of the index. So index makes a change, and then I copy as a manager to get similar index fund return. You won't get the same or above the index fund, above the index returns, but you can nearly match it. And when the index is not moving a lot, if you go with bigger indexes, they will have real good blue chip bigger companies. So that's not going to be in and out of the index. It's going to be there for many decades. So as a manager, I don't have to do too much of it. So there is not enough of much of my effort going into it. So I don't need as much of a fee from you to manage that. So index fund has lower fee that we have to pay to the managers, right? So the managers doesn't have to do too much. We as individual investors doesn't have to do too much because we put the money in that fund and it just tracks the index. For majority of the new starters and those who don't have either time or the knowledge or the interest to kind of read about stock market, this is the real best way of doing it. Historically, it is said the stock market gains about 7 to 10% per year annually in the longer term, right? If you look at the 2000 .com crash, if you look at just the index value for, I'm taking the US index S&P 500, it took 13 years to come back to the same level. So it's called as a lost decade, but you gain some dividends from the index funds, about 2% or so. But from 2013 to 2007, it gained by 300 to 400%, or something of that magnitude. So on an average, it'll be about 7 to 8% annualized.
Could you explain the difference between active fund and a passive one, the index fund, which you mentioned? You know, how does the manager work?
Yeah, so index fund, as I said, explained now, is an example, nice example of a passive fund, right? I just follow what's on index, right? So I don't actively buy and sell all the time, right? So active and passive difference is how frequent you trade the stocks in that fund. The more you trade as a manager, the fund manager, you have to pay the transaction costs and fees. And that will be collected from us as an individual investor. Tarun, you got your hand up.
Can I ask a question?
Among the different index funds we have used, which are the best index funds, you know, among the 3-4 you mentioned?
Yeah, I'll come to that in a second, Tarun. Thanks. Amit, did you have a question as well?
Yes. So, for example, if somebody invests in an index fund, which is what you said is a passive kind of fund, right?
Mm.
So, say, for example, the index is crashing.
Mm.
Would the manager take you out at that point and limit your losses, or you are gone basically?
In between. So manager won't take you out because their role is to just copy the index.
Okay.
Right. But you can sell your index fund and then reinvest after the market has stabilized if you wanted to.
Okay. So it's up to me to monitor that, right?
Yeah. But having said that, you need to be really good at timing the market. Yeah. Okay. So people might have noticed what happened in earlier this year, the coronavirus crash. US stock market crashed, each of them crashed about 35% in a matter of 6 weeks or 4 weeks, which is never heard of. And people thought it would take a good few years to come back. And those stock market indexes are about 20% above where they were before the stock market crash right now. So it came back within 2 months, what people have thought it would take 2 years. And when I say people thought it would take 2 years, it's not people like you and me, it's the financial so-called experts who thought that. When you looked at CNBC and Bloomberg and things like that, people are talking about that. A lot of fund managers missed out on this rally because it defied their usual kind of experience and logic. So even they can't time the market, and we can even kind of forget about even trying to time the market. So time in the market matters more than timing the market.
Oh, I see.
So if you stayed invested from, say, for the first time you invested in January or February of 2020, and then you saw your portfolio crash by 35%. If you stayed invested and didn't take your money off, you would be in profit now by 10, 15% because the market came back. And that is the reason why you have at least 3 to 5 years horizon when you put money in the stock market.
So what's the strategy usually? So when you say you invested and the market crashes, and then when you're up 10%, do you bank the profit, or what do you do?
Yeah, so that is the that will individually vary. Do you settle down for 10%? What's your reason for being in the stock market in the first place? So those things individually will vary. And there is no wrong answer to that. People say you don't go broke by taking profit. There is some truth in it, but it depends on you limiting the losses as well. So I put in one of my posts in WhatsApp group, there are 5 potential outcomes, right, in any investment. Big win, small win, break even, small loss, and big loss, right? So if you take a profit of 5% or 10%, that's a small win. But if you let your portfolio crash by 35%, that's a big loss. So the balance is a bit off, right? And that differs to different people. I've come across what's the word I'm looking for here? A trader. He's a famous trader in US, Mark Minervini. He's also an investing champion a few years ago, a multimillionaire by trading. He does trading for a living and teaching trading and things like that. So he kind of takes profit at 25%, partial profit. So if he invested 100 shares, he sells about 50 shares at 25%, 30% profit. He let the rest of the remaining amount run for as much as it can go. So he books some profit, keeps the rest for him to allow it to go further higher. But if it goes against his plans, he has a risk management and he cuts the losses to small losses. And thereby what he does is he compounds the interest. Does that make sense? So he invests that 25% profit in the next trade and takes another 25% profit on that. So that the second 25% profit would be like 28%. No, what was it? 30% profit because he already had the 25%.
We'll be going too complex here.
Sorry.
I think the reason I'm stopping you is I think I want you to concentrate on another question.
Okay, did I go in tangent? Sorry. No.
That's fine. That's okay. I would go. So I think what we've covered is stocks ISA and cash ISA. We've covered active management funds and passive management. There's a question.
No, I think I answered passive. I didn't answer active.
Just mention active, what the managers do, and then I think people want to know what is the best index fund. If you can say 2-3 characteristics about how to kind of assess a fund, whether it's best or bad or good, and what to look for, then I think we can go to the other important topic is investing mutual funds in India, which will have currencies and everything coming in, so it's a complex one again.
Okay, so the active fund is, I hope people understood a passive fund. So active fund is, I mentioned that I liked like 20 companies and I invest in it. I invest your money in it. And I might use, say, the chart pattern and sell that company and buy something else or I might try to time the market. Say, for instance, beginning of this year, I might have noticed that stock market is coming down, so I sell it. I try to buy it in April, and I saw maybe Morrison stocks going up. Then I buy that, and then book profits at 10% or whatever it is, and then invest the profit in other things. So I'm really actively trying to sell and buy different companies within that fund. So that is active. The manager is actively kind of doing that trades on your behalf. Because I'm actively putting that effort, research, and time, and also incur various costs in trading those shares, I will be getting more fees from you. So we will have to pay higher annual fees and maintenance, sometimes performance fees as well for the managers. But as I said earlier, however experienced you might be, it's very hard to time the market. And that's what the active fund manager is trying to do. Some may be successful, but most aren't. So it's not that much cost effective for us to go with that active fund managers, because they may not be necessarily giving you a return that you couldn't have got from the passive fund like index fund. Some do, but not most people.
Can you briefly mention about sector funds or thematic funds, depending upon which sector is going to grow in next 2 years, give examples.
I'll give an example of what they mean, but I mean, no one knows what
Sure. This is just
will go further.
You just anticipate where you're going to invest. Doesn't mean, you'll make a profit from them. It's just
yes, what sector or thematic fund means is there are companies, there are various companies, right? So I mentioned a couple of them, right? Like Morrison's, right? It's in groceries, it's in consumer. There is Unilever. Have people come across Unilever? Horlicks. Hey, I like Horlicks. That's, Boost is the secret of my energy. That's GSK, or used to be. Dove soap, that's Unilever. So things like that. So that's more consumer faced. Volkswagen, car industry, Vodafone, that's telecom industry. So if a fund invests only in one sector, only in telecom, for instance, or only in biochemical companies, because that's now coronavirus being talked about everywhere. So if companies invest only in medical companies or biochemical industries, vaccine producing companies, they select that as a theme for their investment. So that's the theme of thematic fund, or that's the sector they're investing in. So you won't get other companies in that sector if you select one particular sector. Hope that made sense. Construction based or whatever it is. So you can select based on your assessment of what's likely to happen in future, and you can go with that. But again, that requires a little bit of ability to kind of assess what might be the next best fund, right? I don't know what's going to happen in future, but I've got a kind of gut instinct. Maybe the biotech industry might be kind of coming out of this consolidation. They've been kind of pretty much oscillating in the same level for the last 3 to 4 years, nearly 5 years now. So I have a fund in that's tracking the biotech index, and that's pretty much static.
As Gina Benjafield? Hello. As a doctor.
And I'm looking at the chart. I'm kind of hoping that it will come up. It seems like that, but I'll have to see. So if you have a strong view like that, then you can invest in those type of kind of sector funds. Does that answer your question, then?
Yes, I think it does answer. Now, there's another important question. Do you go with a bank or a private firm for any stocks or shares ISA? Is there any safety features going with a bank, or is it there, what do you think is how safe?
Yeah, I think that's a good question. I do with separate brokerage. I'm with Interactive Investor, but I think Vivek might be in with a bank, and HSBC, Barclays do certain things. Various banks does it. So I think as an individual investor, you just have to see what benefit you get from it. Whether you go with a bank or an individual brokerage account, you get the same protection from FSCS. For your money. But if you're a bank customer, they may give you some offer. I don't know, but you'll have to see whether that is the case or not. for instance, for mortgage, I mean, I had to change my main bank because I was getting a good mortgage interest if I were to change my current account to this bank. So I moved my bank. So similarly, they may have some introductory offer or something. If so, it's worth doing. You just have to then, I think it was you, Nand, you put some links today about comparing different companies and stocks and share ISA, SIPs and things like that. So you have to do a comparison. How actively are you going to trade? Are you going to trade stocks, or are you going with funds and index funds? And what is the fees that you will have to pay and things like that? If it is through a bank, if you want to change bank in future, how will that get affected is also something you may have to check in before you open that account with them.
I would just give you a simple thing, you know, if it's a cold weather outside, some people can, you know, the simplest thing is to wear a jacket with a hoodie. Okay. And that is what I can manage. While some people will wear trendy things with scarf, you know, with a hat, with a gloves and, you know, with a trendy jacket and carry an umbrella. I can't do all these things. So, you know, you need to choose what you can handle and what knowledge you have. While I'll just wear a hoodie. If it rains, you know, I'll just put the hoodie on and, you know, keep my hands inside the pocket. So whatever you guys choose doesn't make a difference. The more trendy you are, you can go for the trends. Sorry, I'm excluding females. I'm just, you know, talking about men's psychology here. But that's just an example, you know, to say in simple words.
I'm conscious of time. I think Vishal has his hand up. Vishal, do you have a question? Vishal Kapil?
Yes.
You're muted, Vishal. Let me try to unmute you.
If not, then I think we want to just know a broad view of SIPs would be another one question.
Yes, there are a couple of questions there. So SIPP is self-invested pension plans. My understanding, others, if you have better understanding, please chip in. My understanding is any of all the employer-based pension scheme, NHS pensions, despite its kind of limitations, is the best one in the market. Right? It's got survivor's benefit and all sorts of other things. Whether you go with NHS pension or private pension through a different company or SIPs, there is this annual limit of 40,000. Right? For NHS pension, if you're on NHS pension, it's not just, I don't think it depends on how much you add to it. They have this kind of very complex made up figure calculation of how much the pension pot would have increased based on the percentage calculation plucked from thin air, right? And if we have a salary increase or a CEA point and things like that, it immediately bumps up. And that is why a lot of people got caught in that kind of annual allowance limit in the last couple of years until it was increased in 2020. So it's fair to assume that if you're a consultant contributing to an NHS pension, you would be very close or to hitting that annual allowance already, if not have done that already. So going with a separate SIPP will take you immediately beyond that, which means you just have to pay tax on it. It defies the purpose of going for a separate SIPP. But not everyone is on NHS pension. So those who are not on NHS pension, I think SIPP, if you are interested in investing in stocks and shares or funds, is a good idea. So government will, we have, again, 40,000 allowance is still there, but you get that, say, 40% from the government. So you don't put all 40,000, you put like 32,000 and the remaining from the government, something like that to make it up. Hope that makes sense.
It would be more beneficial in
Come in.
I think it may be
Good,
more
thank you.
Sorry.
Sorry, Vishal, I wasn't quite sure whether you're talking to us or I've just muted you. So if you have a question, please unmute yourself and ask a question, Vishal. Go ahead, Nand. Nand, go ahead.
Oh, I was just going to typing it. I was just going to say, SIPs might be beneficial if people are flexi working or part-time working or have no NHS pension or who are doing locum as a full-time. So obviously, when I say maybe beneficial means you have to look at your tax and pot and everything. So they're complex decision, but it might suit more to them. or it might benefit in people who are consultants who are doing a private practice and they have a company, their company can contribute to their SIPPs. You might, it's a complex arrangement where you have to seek some tax advice. These are few things. Even a full-time consultant may be able to chip in depending upon when he's joining. If you come at 40, from India and you haven't contributed, your contribution at 50 might be 15 years, while somebody who's turned up after medical school and has been contributing to the pension. So there are so many variables in how much your final pension pot will be. It can't exceed more than 1 million and it will grow with rate of inflation. So these are few things. I think if you Google, you might be able to get some on NHS website, pension website. It might help you to make few decisions. But
how much it grows depends on what you invest in as well, in SIPP, because you can put the money in it, but it depends on whether you choose a fund or a share and things like that as well. Or what type of kind of portfolio, if there is a specific portfolio that you're investing in, then it depends on that. It doesn't automatically grow based on inflation, I don't think.
Just a quick question,
Yeah.
About SIPP. You mentioned that even if you take private SIPP, if we invest, say, for example, £1,000 every month, and are you suggesting that government will be paying 40% to that fund?
That's my understanding, because it's as long as you're not above the annual allowance limit, instead of you at the end of the tax year saying, I put this money on pension, so give me that 40% back, because it's tax deductible. Many of the brokerages, what they do is, if you invest £1,000, then they apply on your behalf and get that £400, which will go to your account.
Right. Okay. Oh, that's good to know. Yeah.
And check, and then you may have to kind of check in with that particular kind of brokerage account if they do that. Many do it. It's the same money, isn't it? So whether you kind of do it at the end of tax year and get it back from HMRC, or they directly invest it in your account. So instead of £1,000, you would invest in maybe like 600, and they put the 400 to make it 1,000.
Yeah, exactly. That was an example. Thank you.
Can I add something? Can I just say something?
Sure.
I'm conscious of time, so I think we only have a few more minutes. Tarun and Amit, I think, had some questions. We shall still have your hand up, so I don't know whether it's a question.
Yeah, got a question.
About mutual funds in India after this, 2 questions.
Sure. Yeah, let Vishal go first.
Yeah. So my question was that if you have equity, if you open an ISA account via an equity fund, can you then open a stock and share ISA as well in the same year?
So equities, stocks and shares. It's the different name for stocks. Equities, it's a different name for stocks and shares. So you can't have the same type of ISA in the same year. So if you have stocks and shares ISA with company A, you can't have stocks and shares ISA the same tax year with company B. You can have, however, stocks and shares ISA with company B the following tax year.
Okay.
Provided
say, for example,
provided you haven't added any money to the company A's stocks and shares ISA.
Okay. But say, for example, I want to do the trading myself, and have, so you can't do the trading yourself.
Sorry, Vishal, you're breaking up. I can't hear you clearly.
Sorry, my question was that you can't do trading yourself via ISA and have an equity fund in the same year.
Okay, let me clarify. Are you talking about having a fund and individual shares in the same account?
Yes.
You can.
Okay.
You can. So I can invest in funds, whether it's active or passive, it doesn't matter, and also trade shares, individual companies' shares in my same account. I do that. For my family, yeah, I do that. So
why ISA, you mean to say?
Via ISA, that's right. But if you go with, say, companies like Vanguard, for instance, so people sometimes directly go to Vanguard for ISA. Vanguard is a fund company. So they only allow you to invest in funds, and that too within Vanguard funds.
Right.
If HSBC has a fund, you can't invest if you're with Vanguard. So they allow you to invest within their own funds. If I go with separate brokerages, I think a few names were mentioned in our chat, whether it's Interact Investor, Hargreaves Lansdowne, AJ Bell, and things like that. You can have a fund, you can have a share, all sorts of things in the same account.
Okay.
Can you tell me why it's ISA? You know, what's the advantage of ISA over stocks and shares about capital gains and unlimited gains in ISA?
Okay, I'll say it in a slightly different way. So there is a cash ISA or stocks and shares ISA. Within stocks and shares ISA, there is a trading. No, sorry. Could you repeat the question again, Nand?
It's there's a separate shares account, okay, outside ISA. You can run simultaneously, where if you in a year earn more than £12,000, which is the capital gains tax limit, you'll have to pay tax 40% about £12,000. But if you invest in stocks and shares ISA, this is not for the starters, but who have a long portfolio. And even if you make, suppose if you make 50,000, nobody has made it, you know, I haven't made it, then all the £50,000 you earn is tax free. So there is no tax on it, and you don't have to report it to HMRC or anything. You can take it out anytime you want. Okay. So that's the advantage of investing, specifically if you have growth companies, which can make you windfall gains. You know?
That's right. And also if you have dividend paying companies that you want to allow it to compound over many years and decades, you don't pay any tax on the dividends. If it is on ISA account.
I would say if you're conscious about time, Vinod, I think the Indian mutual funds investment is a separate topic altogether, considering currency fluctuations and everything. Do you want to wrap it up, or
Can I make a quick suggestion?
Yeah.
Yeah. Go ahead.
Yeah, I mean, it will be useful to people like me that if you can discuss interesting funds, not on maybe today, but maybe on the forum. You can discuss funds or shares that are, you know, potentially interesting at the moment, not asking other people to buy, but it would just give me an idea of how you think about things, so that, you know, we can cotton on to that process of thinking going forwards.
I think we can certainly make use of our group's collective kind of knowledge on that. Just a word of caution though is there are hundreds, actually thousands of funds available in ETF. In US particularly, they've got more ETF and funds than the available companies traded in the stock market. So it will be very difficult for anyone to say better funds, this and that. We can give, maybe people can contribute to some extent, but there's a element of us deciding ourselves what might be based on our investment thesis. Tarun, you had your hand up earlier.
I'm just actually typing.
You muted.
No, I was just typing my bit on the chat. What I was saying that for the SIPP, it was related to the SIPP. You pay about 12.5% is automatically taken from your salary. An employer is giving 20% towards your pension contribution. So suppose you're at 5th year consultant, 85K is your salary, about 27.5K out of your 40K is already being utilized towards your allowance. So you should not try to exceed more than 40K total pot. So you only left about 12.5K to invest in your SIPP. You have to calculate where exactly your total allowance is going. So somebody like me, I've got a bronze award, so I'm 9th year consultant, 40K is completely gone. So SIPP is not an option. If you are 1st year consultant, then you might just be contributing to towards that. So let's just calculate your thing, how much you need to put in SIPP. That's what I'm just saying, and I'm just putting
Yeah,
in the
it's,
chat as well.
I think it's a little bit, you're right. It's also a little bit more complicated than that. I've attended a kind of a workshop by a financial kind of organization about NHS pension. So it's not just about how much you contribute. It's also about how much it's calculated to be increasing in value from previous years to now. And that is not based on any investment. The money we pay automatically from our payslip to NHS pension is not invested in any fund or anything. It's just sitting somewhere. And then the government makes some calculation that 1/80th or 1/64th or something, and various calculations. No basis to those figures. And they assume this would have gone up by this level. And if that level plus your contribution plus your employer's contribution goes above 40,000, then you pay extra tax on it. So it's not as straightforward as I paid, employers paid, that's 27%, I have 13,000 left. And that 13,000 may have been taken out already by this kind of calculation of increase. So it's much more complicated.
What you're talking about is presumed pension growth, and that is included, that goes into 40K. But I'm assuming if you've not had any salary rise, if you have not had any CA award, then you could just almost calculate how much you are almost calculating for this year, which is approximately close to this. But
approximately close to, but this RPI, I think, is it RPI or something like that calculation goes in? It's beyond my head, so I stopped doing that.
I'll keep quiet. I just wanted to contribute whatever I knew. Thank you.
Yeah, I'm conscious that I didn't talk much about individual stock analysis or anything like that. That may not be to this right now either for this group. But one thing that stuck in my mind that was mentioned in our chat was, in WhatsApp chat, was when I put a stock chart. I don't remember who it was, whether it's Mohan or somebody else, who said it's like, I can't understand what these squiggly lines are, which is really nice to see. But that kind of makes me notice that actually, yeah, I've been seeing this stock chart for the last 13 years. So I can't expect people to know that intuitively. So if there are people interested in understanding stock charts or kind of dipping your toe in kind of how to look at it, what they are and things like that, maybe we can have a separate meeting for that.
Absolutely. I agree. Thanks a lot, Vinod. I think you spent more than sufficient time trying to explain quite a few things. From what I realized from what our other colleagues spoke about the pension for SIPP, you're right. I think it's a much more complex calculation. And at the end of the day, you don't want to be paying into something which you're going to be taxed all over again, because you're paying previously taxed money into it. So I think overall, one definitely needs some form of person to give us a bit of guidance, not yourselves or not on this group, but maybe even our the chap who's doing our tax returns, our tax accountant might be able to give some idea about that.
Thanks, John. You're right. I just want to add one more thing before we wrap up, which is think beyond ourselves. Because why do we think about financial growth? I mean, yes, it helps our old age and all that, but also we also tend to think about our next generation, right? Why do we work so hard? I mean, we can easily survive with half the salary if it is just us. We think about the financial security for our kids. And so make use of the junior ISA. So kids are allowed ISA accounts as well. And if you either put index fund, we spoke about on an average in the longer term, it gains 10%. And if you start when they're born, for instance, they've got however long they want to keep it, multiple decades to compound that, right?
True.
And it doesn't have to be a huge amount. They have recently increased the annual allowance. It's 9,000 per junior ISA per year. Previously, it was about 4,000 something. And a few years ago, I had a family member who is a medic. She was just about finishing her MBBS, and she was doing the internship in India. So I wanted to kind of introduce this concept of saving, investing for life. So I took her on and did a brief calculation, back of the envelope calculation, just based on her internship fee, was stipend, right? So if you save about 25% or 30% of your stipend, let's say it's 3,000 rupees per month, right? Per month, just add every month 3,000 rupees to your investment account, right? No fancy investment, just 10% compounding index fund. And let's assume that she is 25 years of age, and let's assume she does it just 3,000 rupees per month for the next 40 years until 65. She's not going to be an intern for 40 years. Of course, she will qualify and earn a lot more, but just with that basic calculation, 3,000 rupees per month, she will be a crorepati at 65. In fact, she will have nearly 2 crores with just 3,000 rupees per month. And that's starting at 25. Think about what could happen for our kids who may or may not be 25. Most of us, I think, will have younger kids, right? And thankfully, I mean, I didn't know about stock market investing or compounding until quite late. But thankfully, I knew of it before I had my kids. My kids have junior ISA from the first year onwards.
Yeah.
Right. And that's been compounding. I think I've mentioned in the chat as well. I'm kind of doing, I don't know how they will react when they turn 18, but I've got 2 kids and I'm kind of experimenting with that account a little bit. So one of them have growth stocks and the other one has funds, to see how they both compound over the years.
Some form of single blind study, is it?
Yeah, case study.
Quick question. Like, you know, we are all beginners in this situation, and there are so many books that have been put out, and most of these books are available as well online on Amazon to buy. Good question. If I were to ask you, give me 2 books that you think is absolutely mandatory for somebody to start learning these things, which ones would you suggest?
Okay, I'll just give me 1 second. Let me get the book.
Okay. Rich Dad, Poor Dad is a good book.
There are so many. It's very difficult to choose. It's like choosing between your kids, who is your favorite.
But remember, we are all beginners, so it's not difficult.
Yeah. So that's why I'm kind of thinking more on the foundation of it. I'm not talking about stocks with these books. I'm talking about the mindset of saving, investing for future growth. So you asked me 2, but I think you asked me twice that. So I brought 4 books.
Compound interest, eh?
Yeah. You asked me once and you get 2. So this one.
Yeah. Okay.
So it talks, so that one. And these 2 are by the same authors, mom and daughter.
Okay. Elizabeth Warren.
Elizabeth Warren. Is she the one who ran for the presidency as well?
Probably.
Yeah, she did.
Yeah.
Okay.
So it talks about some of the mental traps that we fall into. Say, husband is working, wife is working, everything is fine. Let's get this mortgage. Let's get that loan and things like that. And all of a sudden, someone is furloughed. Something happens. Someone gets ill, and then we are in a big mess. So these books talks about the mindset of how to not fall into that 2-income trap, and then to think wider aspects of it. And this one. This is also Tony Robbins.
Okay. Fair enough.
You mentioned Rich Dad, Poor Dad. That's also a good one. There's so many things. But if you just want to work on the mindset alone, Think and Grow Rich is a good one. Napoleon Hill. It's nearly a century old, but every word is as relevant now as it was last century. Think and Grow Rich.
Thanks for that.
Thank you. Thanks, Nand, for the question for helping me with that. Ragini, did we miss anything? Any chats or any questions? Any comments that you want to add?
I mean, there are a few things we didn't go through, but I think we've gone through a lot. So
thank you.